Let's bring in my first guest, Michael Guyot from Pension Partners. Michael, you heard what Roger McNamee said about us being in the trading range, that maybe we're going to get stuck for a while. What's your take?
Yeah, it's certainly a possibility. Look, everyone's been looking for a big correction. Now, it looks like we could have had one the last 2-3 weeks. The conditions were actually pretty negative internally within the market. One way that you can have a correction actually is by going sideways for some period of time, right? So that you actually don't make big money in equities before another leg higher. Now, I do think that we're very likely here going to push two new all-time highs sometime in the next 2 months, purely because at these low yields, at some point, money's going to start saying, well, wait a minute, the inflation target of the Fed is 2%. And I'm earning less.
And the 10-year is at 1.93%.
Right. Meanwhile, Apple, which one could argue is in many ways safer than the U.S. government, with cash, with no debt, has a yield that's roughly equivalent to the 10-year Treasury. So there becomes this asset allocation shift, which likely is coming out of risk-free into risk, which I've been calling the spring switch.
The spring switch. If you're correct, and if we do move higher, does that reinforce the concept that contrarian investing is the way to go? Because, you know, if everybody talks about a potential correction, I got to think that there are some investors who say, as long as people talk about a potential fall, stocks will continue to climb.
You know, it's funny. When people think about contrarianism, it's usually in terms of direction, up or down. I think actually the contrarian trade now is to bet on time, the length of time that the trend up persists. We're used to this environment where things go up and down very quickly, that trends are fleeting. What if this is like 2003? What if this is like 2009, whereby coming off of a deflation scare, you have reflation and risk assets, just to the surprise of most, continue to make highs?
So maybe the idea of selling your stocks and going away in May and coming back after Labor Day isn't going to work this year.
Yeah, I actually very much think so. This idea of sell in May, go away, you have to understand why that's historically worked and what the strategy is. Part of the sell in May, go away strategy is actually to go into bonds out of stocks for that 6-month period after May. Now, the problem is yields are already at these panic low yield levels. So if you're going to do the sell in May, go away strategy, you're automatically going to go into bonds, but bonds have already done so well. So do you want to chase bonds? Do you want to chase performance at what could be a peak? Or do you want to bet on the thing which nobody else is betting on, the most unloved asset class, stocks?
All right, we're going to get to stocks in a second, but you said something very interesting. You said panic level when you talk about yields. And indeed, if you just looked, if you sort of landed from Mars and took a look at the 10-year and said, all right, it's 1.93%, boy, things are just terrible. But they're not really. I mean, we got the GDP print today, 2.2%. It was less than the economists had forecast. They were all looking for 2.5%. But the personal consumption part of that was higher. Consumers seem to be spending money.
It's really a question of, are these low yields indicative of the economy or stimulative to the economy? Do these low yields reflect what is otherwise would be seen as a depressionary environment, given these real panic low yield levels, or is it going to cause a massive shift in risk taking? I remember, I recall Bernanke in his latest speech when he announced the policy said, you know, he had this sense that maybe things were just starting to just pick up out of nowhere because it hasn't picked up for so long in a really big way. So, you know, things happen in very unusual patterns sometimes. Maybe it just is going to start to pick up in a real, very powerful move here.
Well, you make a good analogy, because I'm wondering whether it's possible that people are expecting slow, gradual improvement, when in fact that might not be the way things move. It may move in a kind of stepping stone kind of situation where you get big moves up, big moves down, because no one is really sure about the health of the U.S. economy and particularly the relationship of the economy to what's going on in Europe.
And yet the DAX index, Germany's equity average, is up to 6,700 from 5,000. Europe itself, despite Spain, is acting fairly resilient. European financials look like they've washed out relative to our own banks, which suggests that maybe the financial crisis is easing. So what's interesting here about stocks is that I would argue rising stocks are much more stimulative than low interest rates. Rising stocks through the wealth effect can cause a better...
people feel that they have more money.
Right, so their 401ks go up, their individual investments go up, they feel that things are improving, they start to spend more. That velocity of money in the economy, that movement of cash starts picking up. That in turn creates almost this very powerful self-fulfilling prophecy that Spain is not going to be able to counter.
So what kinds of stocks do you want to be invested in? Because we took a look at some earnings reports today. We got Deckers Outdoor. They're the maker of UGG boots and Teva sandals. The stock gets crushed. It's down 25%. That didn't do well. Procter & Gamble, the world's largest consumer products company, all right, they said that they had to pass along some price increases and they weren't able to all the time. The stock fell. People are a little concerned there. Where do you put the money?
So it looks like the entire world is really waiting on China to lower rates. If China lowers rates, commodities likely will reflate in the next wave higher, coinciding with a move back in emerging markets. So I think the global cyclical play is just about to kick back in. You know, the U.S. stock market.
So we're talking what, like mining companies, Freeport-McMoRan, copper and gold,
right.
Rio Tinto, companies like that?
The energy sector and the materials sector have both pretty substantially underperformed U.S. financials and the U.S. stock market more generally in the past 5 months. Now, I believe the next move here, the next rotation, likely is going to be into that global growth story as China, acting as a catalyst, lowers rates.
All right, so if you want to buy into that global growth story, I mean, am I right? I mean, do we want to focus on miners? I mean, you talk about energy, too. We got the report from Chevron today. It turns out that even though they're looking at higher oil prices, they weren't able to translate that into higher profits because they can't get enough out of the ground.
Right, but that's also the exact reason why money can go into those stocks. Money tends to go into stocks which are just starting to turn around from a fundamental perspective. The energy sector has lagged as financials have led. Financials can continue to outperform, but if the consumer is okay, if the jobs market is improving, if China comes in and starts to reflate domestically, that demand in commodities, that demand in anything that miners themselves are mining, will pick up. The expectation will increase for further gains ahead in the commodity space.
Michael, I know that I'm going to force you to look ahead a week because we got the unemployment report next Friday. Do you expect us to see a down move in unemployment in the United States?
It's very possible, but I don't think the stock market cares. Either way, if it disappoints, QE3 bets are back. If it's better, then the Fed is right all along.